Now, as inflation continues to surge strongly in East, West, South and Central Africa, the World Bank is now warning that could trigger a lot more widespread social strife. The warning is front and center in the April forecast of economic growth trends across the region. The bank estimates that growth in 2021 was slightly higher than initially forecast at 4%, at 0.7 percentage points higher than the October forecast. The acceleration was driven by slightly better than forecast growth in tentpole economies like Nigeria and South Africa, as global trade recovered, commodity prices rose, and of course some pandemic restrictions were lifted. Now, the growth forecast for 2022, however, is lower at 3.6%, excluding Nigeria, Angola and South Africa. The rest of the region is forecast to actually grow at over 4%. Now, as a result of the economic upheaval in global oil and food markets in the wake of Russia's invasion of Ukraine, the World Bank now sees emerging signs of stagflation even here in Africa. Between them, Russia and the Ukraine account for roughly 2%, less than that actually, of the region's imports. But the big producers in commodities that the region is highly dependent on: wheat, maize, fertilizer, sunflower oil. Now, rise in the prices of these things, plus of course a rise in the price of oil, simply cannot be dealt with by central banks just raising interest rates, particularly in a region where, on average, food expenses make up 40% of household spending, especially among poorer households. The third plank of the World Bank's regional economic review is on public debt. The bank was unequivocal in saying that the DSSI and the G20 Common Framework have both essentially failed to head off a potential debt crisis. Over 60% of countries in the region are now at high risk of debt distress. Across the region, countries owe more to private creditors, nearly $200 billion worth, than they do to either multilateral institutions or to bilateral creditors. They took up roughly 2/3 of the region's $40 billion in debt service costs. Chad, Ethiopia and Zambia, they've all sought debt relief under the G20 Common Framework, but there's been very little progress made so far by any of those countries. Some hours ago, I spoke with the World Bank's chief Africa economist, Albert Zeufack. I started our conversation by exploring if governments here had really learned lessons from the last major food price crisis back in 2008.
We believe it's an important platform because it could allow countries to avoid mistakes of the past. You know, if you take the 2008 crisis, food crisis, countries actually closed borders instead of opening them, and that contributed to actually worsening the food inflation instead of solving it. So the Africa Continental Free Trade Area, by promoting an intensification in cross-border trades within African countries, can actually be a clear solution to this problem. But more importantly, the solution would actually come from really boosting the productivity of agriculture across Africa. Africa imports close to $40 billion of food every year, while we have the potential to be the breadbasket for the whole world.
But you and I have been, operating across the continent for quite a while now. We've seen these conversations that we're having around expanding trade, especially on agricultural goods within the continent. That's not new. Countries across the continent are yet to actually meet even their own self-signed up to declarations on the Maputo Declaration, for example, to increase the amount of money that they're investing in their agricultural sector. Agriculture often tends to be a beneficiary of protectionist policies over the last 2 decades. I guess the question anyone would ask is, what's different this time round? Why should we have hope that policymakers will open up their borders instead of closing them down?
I think what has changed is the collective understanding across Africa that most of the solutions to our problems, including solutions to the food crisis that may ensue if this crisis continues, the collective understanding in Africa that solutions to our problem would have to actually come from within the continent.
One of the things that you also argue is that we've seen governments across the board implementing some sort of subsidy measure in some cases to try and essentially limit the pass-through effects of these increases in the cost of certain foods and of course fuel as well. But the bank's report is arguing that those are often very inefficient ways of dealing with the problem. So if subsidies are not the answer, because there really isn't the fiscal space to actually pay for them, what is the answer?
What the report is arguing is that governments need to distinguish between short-term and long-term measures to this situation. The more short-term measures, subsidies are probably the most distortive, because if you take energy subsidies, for example, they actually benefit largely the richer segment of the population. So in Nigeria, for example, less than 5% of those subsidies actually go to the poor. So it is important to avoid further distorting the economy as we try to address this surge in prices. What is clear from our perspective is the inflation shock here is mostly driven by supply constraints. So the kind of policies that need to be implemented may differ from the kind of monetary policies that are implemented in the USA, for example, where inflation is actually demand-driven. So what we're suggesting is that countries use a blend of fiscal policies, monetary policies, trade policies, deepen African integration to address this question.
This circles back to the question around debt, because that's also the third pillar around which the report is based. 6 out of every 10 countries in Africa now essentially at high risk of debt distress. And one of the things that you argue in the report is that the DSSI and the G20 Common Framework have not achieved their goals of lowering the odds of debt distress, making it easier for countries to restructure their obligations. Why do they fail?
First, the DSSI was meant to address liquidity, short-term liquidity issues, not solvency. So we should not expect the DSSI to actually address the issue of debt sustainability in Africa. So the DSSI gave a little bit of breathing room, a little bit of fiscal space for some countries that benefited from it, and allowed them to delay the payment of interest on that debt. And that was useful to fight the COVID crisis. Now, the DSSI faced what I would say 2 important issues. One, middle-income countries in Africa that have access to markets for private borrowing, access to private credit markets, were not very enthusiastic to embark on the DSSI because of the fear of being punished by rating agencies. Indeed, rating agencies in Africa rather considered DSSI as the beginning of default, while it wasn't. So that's certainly one thing. And the second difficulty was to bring creditors, private creditors, around the table. As you may know, most of African debt is now due to private creditors, not to the World Bank or IMF, not to bilaterals. Bringing all the private creditors around the table, depending on the country, is an issue. And that's also the same problem we're facing in the common framework.